for joining us today. My name is Katie Cichosz, and I'm a realtor with Abbitt Realty here in Newport News, Virginia. And I'm joined today by my number one trusted preferred lender.
Hey everybody, my name is Carter Hartley. I'm a loan officer with Tidewater Home Funding, also here in Newport News, and I'm excited to be joining y'all.
Thank you so much for coming. I appreciate it.
Thanks for having me.
So we were talking the other week and it came up that we have some first-time buyers that actually have a lot of questions that I think you would be able to answer for them.
I would love to hear them.
Perfect. Let's get started. So Carter, one of the most common questions that I get is, what does my credit score need to be in order to purchase a house?
That's a great question. We look at a lot of different factors when qualifying somebody for a mortgage. Credit is certainly the largest one. Your credit score plays a large role in the qualifying process. Your credit score determines the amount of interest that you pay. The higher your credit score, the lower the interest rate. That being said, most of our investors are looking for an applicant with a score of 620 or above. However, we do have some programs where investors will approve an applicant with a credit score of 580 or above. Now, these applicants will have to pay a higher interest rate, may have to put more money down, and must have a debt-to-income ratio of 45% or below.
Great answer. Well, speaking of debt-to-income ratios, would you be able to go more into detail to help explain to someone who's not familiar with what that is, kind of the impact that it has and why it matters?
Definitely. The debt-to-income ratio is extremely important during the qualification process of a mortgage. Most investors are looking for applicants with a debt-to-income ratio of 45% or below. Now, how we calculate this, we take the applicant's gross monthly income, and then we add up all of their debts that they have, whether it's car payments, credit card payments, student loans, other mortgages, personal loans, anything like that. So we add those all up with the proposed monthly mortgage payment, and then we divide that by the applicant's gross monthly income. And that is how we determine what your debt-to-income ratio is. And the reason the debt-to-income ratio is so important is that proves to your lender that not only can you handle your current obligations, but you can also handle the proposed monthly mortgage payment while still maintaining enough funds to live your life.
Thank you for that general overview. I know that a lot of my clients will find that helpful because many of them haven't even heard of a DTI ratio before. Another one of the really common questions that I get, Carter, is how much do I need for a down payment?
I get that question a whole lot too, Katie, so I'm definitely glad to go over that. Many people still think that the requirement for a down payment is 20% of the purchase price, and that is just not true. Down payment requirements vary from different loan programs. Say you want to buy a house in a rural community, or if you're a veteran and qualify for a VA loan, you could have a home loan as not even a first-time home buyer with a zero down payment. There are still some loan programs that do require a down payment. For example, FHA requires that you put down 3.5% of the purchase price, and conventional loans require that you put down 3% of the purchase price. For a better understanding of the route that you qualify for, please give me a call, and that way we will get you on track.
Awesome info. Well, to get in touch with Carter, make sure you check out the description below for all of his contact information, or reach out to me and I will make sure that you guys get connected. Next question for you, Carter. What if some of these individuals are concerned that they won't be able to qualify for any of these variety of programs that you've mentioned?
So the first step is to reach out to me. Every loan is personal and requires a one-on-one conversation. After we have that conversation, I'll be able to judge what your goals are, what your current qualifications are, what you want to qualify for, and develop a plan to get you there. So let's say that your credit is not where it needs to be yet to purchase a home. For applicants who are not quite ready to purchase a home, whether it's financial hardships, credit hardships, any of the above, I offer a credit coaching program that can take 3, 6 to 12 months. But if you follow the steps, they will lead you to the path of homeownership.
Carter, last question for you. What is the one question that people should be asking and they're not?
In my opinion, the question that most people should be asking their lender is, how many programs do you offer? Most lenders only have 2, maybe 3 options for you for a mortgage. It is very important that you work with a lender that you trust and will find the best option for you. In addition to this, I always say work with a local lender who will take the time to walk you through the entire process and make sure you understand. Buying a home is the largest investment a person can make. You deserve to know what you're doing and know what you're signing.
Well, Carter, I want to thank you so much for coming in and sharing your expertise and insight with us today. I know this information is going to be very helpful, not only for first-time buyers, but anyone else that wasn't really familiar with the terms.
Well, thank you for having me.
My pleasure. Guys, check out the links in the description below. Contact info, lots of other resources available for you there. Don't forget to subscribe to our channel and check out any new videos that we have coming out. Thank you.
Thank you. I'll see you next time.